All right. Good morning, everyone. My name is Amanda Jarvis, and I'm with the Virginia SBDC Network. For those of you that are not familiar with our organization, the Virginia Small Business Development Center is a partnership program between the U.S. Small Business Administration, George Mason University, and local host institutions throughout Virginia. With 27 locations across the Commonwealth, we provide training and technical assistance to small businesses in their local communities. Our one-on-one consulting services are available at no charge. Today's webinar, Craft Beverage Finance, What You Need to Know Before Speaking with Your Banker, is presented by the Virginia SBDC Network Craft Beverage Assistance Program. We are recording today's presentation and it will be posted on our website, virginiasbdc.org. Due to the large number of participants, everyone's microphone is muted, but if you have questions during the presentation, you can type those into the Q&A box. So that's going to be the Q&A box, not the chat box. We have also enabled the live transcript function, which you can show or hide via your meeting controls. And now it's my pleasure to turn it over to Chris and Jason.
Thank you so much. Good morning, everyone, and thank you for joining us today for this conversation about financing a craft beverage business. My name is Chris Van Orden, and I'm the manager of the Craft Beverage Assistance Program at the Virginia Small Business Development Center at George Mason University. The CBA program is designed to provide industry-specific technical assistance to Virginia's craft beverage sector. So today's program is going to be a free-flowing conversation rather than a kind of presentation per se. And we're going to touch on a variety of issues related to the funding of a craft beverage production company. We'll leave a good amount of time for questions and answers at the end of the program. As Amanda mentioned, we have that Q&A box there, so feel free to add them as they come up and we'll address them at the end unless we happen to cover that material along the way. So I am thrilled to introduce Jason Sleeman, Vice President of Craft Beverage Lending at United Community Bank. With his deep understanding of both finance and the craft beverage industry, Jason has helped breweries, wineries, and distilleries access capital. Welcome, Jason, and thanks for sharing your expertise today.
Hey, Chris, thanks. I'm excited to be talking about this today. It's super fun and hopefully educational.
Absolutely. Well, first things first, let's talk fundamentals. What are the financing options that are available to small businesses in the craft beverage space?
So it's kind of all over the board. And I would tell you that with the continued invention of technology, that has, changed. And so, there is size and scope sometimes dictates where we go with one option or another. And so, I'll probably talk a little bit about startups and then we can talk about expansions too, just kind of tell you what's out there. But, from a traditional banking, if we're talking about a startup, the number one place is going to be the SBA. That the Small Business Administration is definitely a partner. And I listened a long time ago, people, if you ever listen to the Freakonomics, there's a podcast and they talked about the fact that the SBA doesn't do a great job of branding themselves. And people think of them as the lender of last resort, but they should be thinking of them as the investor of first option. And part of that is because most of the time with the SBA, especially in a startup, it's because you don't have historic cash flow. And so the first place that I tell people to turn is looking at the SBA. And depending on what you're using the money for in the early going, I would say that 90% of startup craft beverage projects are going with a SBA 7A. So the general catch-all allows for the working capital or, leasehold improvements, kind of anything that they're going to need. If there's a large real estate component or a really heavy capital component of it, they may be looking at the 504 as part of that product. And that's really going to be something that you'll have to decide which way to go as your project leans. When people look at non-traditional banking in the startup realm, they look at a lot of different options. So, I hear people talking about investors. So they go out and investors come in, a couple of different routes. A lot of times that's, hey, people like the beer or the spirit that I make or the wine that I make. And they said, you tell me when you're ready to open and I'll give you some money, right? That is early on, I would say 5 years ago, you had people just clamoring to do that. COVID has kind of put a little bit of a kink in that. And so there's not as many people who are willing to kind of just put their money out there. And so there are some, especially in the alternative lending space, there are two other programs. And I refer people here pretty regularly because sometimes they work in tandem with that, with us lending. Sometimes, depending on the size, if it's really small, they may be the only option you need. But there's a group called Mainvest, which is crowdsourced debt. So if sometimes people have had a problem in the past, they've had a bankruptcy or they've had something that didn't go wrong and traditional banking's not for them. And so Mainvest is there. Also from a size and scope perspective, that may be an option. And then there's a place called WeFunder that does crowdsourced equity. And so it's kind of, if you don't have enough friends and family to get the equity in there, WeFunder may be able to help you with that. Adding on, if you're talking about an expansion, there's probably one additional option, and that's just kind of conventional bank financing. You've got good historic cash flows, you've got good, kind of income and assets and things are going. And so you may have conventional lending. But I would tell you, I love the SBA program. And I would tell you that sometimes even on an established brewery, the SBA is a better option just because of the amortization and the equity injection, all this kind of thing. So I would tell you for, brewing and distilling and the wineries that, in my opinion, the SBA really has kind of the products that you want. And you have to look and see if the 7A or the 504 is program for you.
Absolutely. And I should say anybody who's trying to find, a bank that carries SBA products, you can reach out to your SBDCs. Jason obviously is very familiar with this because he's, he works a lot with these products as well. So finding the right bank for you is really important when it comes to getting those SBA products.
Yeah,
so
I would tell you a lot of times that's my first step. When someone shows up and I start asking about business plan projections and I see a glazed eye, the glazed eyes, I say, great, let's find the SBDC for you and let's start there. And that's, for me, that's a great place. Probably because I know I'm going to get really good data coming out of it. It helps with the lending that I'm going to do.
Absolutely. So as you mentioned a little bit ago, financing, kind of what the options available, looks different for your startups, your companies in planning, and existing companies. So let's start with the former, the startup space. When in the process of launching a new business is a producer in planning ready to speak with a banker? I realize that might be a little bit of a loaded question or difficult, but when is somebody ready to come to you?
So right now in this COVID time, I would tell you that things are taking way longer than they should. But earlier is always better. And I would tell you there's probably a little bit of homework that you want to have done before. And one of the first questions that we're going to ask you is, tell me about your experience, right? And so I always tell people that, people think that owning a brewery or owning a distillery is just the coolest job ever. They don't really know the ins and outs of it, and they think you just prop up your feet and are drinking bourbon all day or drinking beer all day. And the very first thing that I would tell you is I had a client who was a startup, and they got through the startup phase, and the head brewer and the owner had a falling out 4 days before the brewery opened. And there was a kind of an, oh goodness, what do we do now moment. So one of the first questions I'm going to ask is about your experience. So a lot of people are home brewers. A lot of people have distilled their own gin. A lot of people have done whatever. I really would like to see that you've been in the industry at some point. You either work front of the house and you kind of understand how the POS systems work and the tap lines work and dealing with the customers, or you've worked on the backside, and that may be washing kegs and sweeping floors, or it may be being a brewer and going out on your own. And so understanding that experience, and even if it's not in the alcohol industry, maybe you ran a restaurant before, maybe you've run your own small business, but having something to do, because with the first day that in a startup phase, there's a chance that, depending on how long it takes for your business to get up and running, you may struggle a little bit with that, right? I'd also say kind of having a general idea of where you want to be is important. I started talking to a gentleman who said, hey, I'm going to move from Colorado to Florida. He went out and scouted the territory and said, well, I can't find really what I want, so I'm going to go back to Colorado, right? And so kind of knowing, do you want to be in your home state? Do you want to be in someone else's home state? And, it's also understanding the laws in those states, right? So when you come to me kind of saying, hey, I want to be a production brewery in Georgia, looks a lot different than being a production brewery in Kentucky where they can self-distribute. So understanding, what are the rules and how are you going to play with those. The other thing that I would tell you is starting to really focus on yourself as an individual. In a startup, my favorite phrase is that as a startup, you cannot separate yourself from your business, right? As you're much further down the road and established and you've got more investors and you've got really big assets, you got things like that, you can really separate yourself. But early on, you are the business, right? Until there's revenue there. So you got to understand what's on your background check. Chris, this may not surprise you, but underage drinking shows up a couple of times, or doing something that you shouldn't have done, a little no-no happens sometimes in the background there. So we got to figure out how we get past that. Also, you got to understand your personal credit. So again, because it's really relying on you, how do you watch your credit? Did you just declare bankruptcy weeks ago? Do you have a lot of lates on your credit cards or your mortgage or something like that? That's going to be a really, really big tripping place for you. And then the other part is kind of understanding your personal financial statement and net worth. I've been lending for 20 years and I've been doing craft beverage for about 8. And I got a personal financial statement one day. When we calculated, it had a negative net worth on it, right? So it was someone early in their career. They didn't have a house. They didn't have any assets. They really didn't have anything saved up. And on the right side, they had a lot of student debt. They had a lot of things. And so when you get their net worth, it was negative. And you said, geez, that's a problem, right? So there's a lot of things where you look at it where you got to say, hey, do I personally have my house in order? Do I generally know where I'm going to go? You don't have to necessarily have the exact location identified, but what state do you want to be in? You kind of want to know, what do you want to be, right? Do you want to be a production facility? Do you want to be really focused on the tap room? Do you want to be a brewery? Do you want to be a brew pub? Do you want to be a state winery? Do you want to just be a contract winery? So just kind of understanding, just generally having kind of understand your identity. And then, I would also tell you that, early on, one of the things that really is hard for both the bank and you is if you go out and get a bunch of small investors. So if you go out and every friend wants to invest $500, it is a lot of headache for everybody. And so trying to reduce maybe that and try and get 1 or 2 larger investors, if you're going to rely on investors, is going to be important.
That's great. Yeah. I know it can be difficult sometimes to do that honest self-assessment of, you have a lot of passion, and even if you have all the other places and pieces in place, being aware of how you appear on paper is a big part of that. And some of those things can be addressed through some strategic planning. So let's say somebody goes through that self-assessment, says, hey, I think this is the right time. I've got a good sense of what I'm trying to achieve with my company here. Everything's roughly in place. I'm far enough along the line, but I know that there's going to take some time. What information should that person bring to you when they're in that pre-launch phase to begin having a conversation? You mentioned a business plan, and the SBDCs are a great source for kind of developing something that a bank, will kind of understand and appreciate, something decently put together. But what other information should they have in hand?
Yeah, so I would say that, from a business, especially focused on the startup side of it, right? So from the business side of it, it's that business plan. And I always joke, I don't know, I wasn't the best student in school. That doesn't mean that I didn't become very good in that kind of stuff. But the 100-page business plan is something that I think, is a little unnecessary. And you start getting a little bit lost in that. And so the first thing I would say is a clear, concise business plan. And that business plan is what's your identity. So, what do you want to be? How do you want to do it? Where are you going to find your margins? Have you identified the ownership? Have you identified those pieces of it, right? So do you have the key components of what you want to be there? And so, in this world right now, I would also lean in the fact that, as part of your business plan, it's probably worth talking to a general contractor and an architect, not necessarily that you want to retain them, but as part of your business plan, there's usually sources and uses in there. And so one of the things that I'm finding, especially in the current market, is someone kind of eyeballs it and says, yeah, we need $500,000 to do this project. And then we go down the road and I say, hey, if you actually had someone look at this, I think we can get this deal done for you. And they say, well, we really haven't talked to anyone. And I said, all right, go engage someone. And then all of a sudden it comes back and it's 1.2 million to do the build out that they thought. And all of a sudden now their equity's all out of whack. The bank has to go back and relook at things. So I would say as part of that business planning, it's also kind of understanding where you're going to go, and have you had a professional like either an architect or a GC kind of do a run through, and then kind of as you're building that along, you're building your sources and uses, and then you're kind of building your pro forma, and that would be the other part of it, is understanding the pro forma. It's very rare, but it does happen where someone will send you a pro forma where they don't cash flow. I had a gentleman the other day who basically sent me a pro forma, went through that exercise of saying, yeah, this looks good, and then came back and said, just kidding, we need another $1 million. And I said, well, your pro forma doesn't cash flow now. And he said, well, this is what we're going to do. And I said, well, you can't be negative for 3 years. I was like, it just doesn't work that way. And so you kind of got to have an idea of what are you going to do. So based on how big the project is, how much beer are you going to sell? Or are you going to be in, the spirits business? Are you going to sell a lot of cocktails and, distribution? So kind of understanding that and being able to build a pro forma.
Jason, real quick, there was a question. Can you define pro forma?
Sure. Even to a simpler level, I just tell them it's projections. So it's you taking an educated guess. So taking here, we think we're going to sell this. And in the beer industry is a really easy example, right? Because when you get into spirits and wine, you may be selling a 6-year bourbon and a fast gin, right? But beer is pretty easy, right? You can look at it and say, hey, we're going to sell, $5 pints in the tap room, and that's going to cost us 50 cents. And I think that the average person's going to drink 2 on, Monday, Wednesday, Friday, and 3 on Saturday and Sunday. And you kind of start building it together and you say, okay, we can build this many barrels. And so you're taking a lot of educated guesses. Chris, you're clearly going to be a good resource for that because you've seen them before. But you're going to say, hey, look, we're generally in this area. We think we're going to be a taproom model. And I'm going to project out, here's what we think we're going to do in year 1. And then we think maybe we'll grow 20% in year 2 and year 3. I have to joke a little bit, and I don't know if you saw this video, but I interviewed a brewery that we financed 5 years ago, and he talked about the reality of his business plan and the actuality. In Georgia, at the time he did his business plan, you couldn't actually sell beer directly to the consumer. You had to give them a tour for $12 and you gave away free beer. Well, he said, now we're at year 5 and we sell beer directly to the consumer. We have ready to drink cocktails because they got a DSP. We have a cider brand. We have this beer that we didn't even think we'd be brewing is now one of our major sellers. And so I tell you, it's all future casting, and that's what the bank's going to kind of go on. But reality may just burn it, and you don't really know what's going to happen. But it's kind of your best guess at in today's market, in today's environment, what you think you're going to do.
Absolutely, yeah. The pro forma can sometimes feel like an exercise in hubris, because who's to say? 2 years ago, people's pro formas are probably blown out of the water at this point, given everything that's happened. But as much as possible, benchmarking that, right? Going out there and saying, well, I know roughly what another company of my size is doing. I have some grounding in this just to make it feel real. And honestly, all of that helps with conversations with people like Jason. Ideally, it'll also help you sleep better at night, knowing that there's some path to profitability here, because otherwise it's all, hey, people want the product. Well, you could be absolutely operating according to your plan and still not be profitable unless you do this exercise. So kind of putting together a strong pro forma is going to be useful for a lot of aspects of your pre-launch business.
Yeah, and kind of all of both of those two wrap around maybe kind of the other things that I would say. You and I talked about just kind of understanding the letter of support. So it is another example, right? You do this long enough and you realize we had a business in Atlanta that was under contract. We're trying to get the zoning changed. It was contingent on the zoning. They went to 3 zoning board meetings. They couldn't get the zoning changed. And so they packed up and went to New York, right? Just kind of crazy thing like that. And so understanding, and I can kind of speak for some of the states I'm working on right now. A lot of the municipalities have come to understand that craft beverage is not the local dive bar. It is a family attractor, it is high-end clients, it's people with money, right? I mean, if you're buying a $7 pint as opposed to $1, kind of sudsy beer, you've got a little more influence and things like that. And so there's a lot of incentive out there. And so understanding that early on is, I'm going to this place and they're going to, the builder is going to help me with incentives. The city is trying to help the laws and be able to kind of understand that, right? That's a lot of work. And that's where I tell you, you've got to surround yourself by experts and people who can help you with that, right? So the local craft beverage attorney, the local real estate guy that really kind of understands that, the insurance person. And so, just kind of understanding those pieces are going to really help the early ball kind of get rolling and go from there.
Absolutely. And when you're going to enlist that support, trying to get some traction, getting, a sort of a friendly landing when you're, that's half the battle. I know plenty of people who spend their entire time just battling the city or their landlord. Think of yourself not necessarily as a brewery or a winery, cidery, distillery. You are an agricultural value add light manufacturer that has in a labor intensive industry that can serve as an anchor for redevelopment. You kind of take out what the product is, which sometimes people say, oh, alcohol, that's fun. Everyone that's in this call probably is aware how intensive this industry is. Capital intensive, it's labor intensive. So when you start kind of listing out the things about this industry that makes it attractive for a town or a county to support, that can really help you to get that traction, to get that letter of support. Really, you kind of say, all right, we feel pretty positive about our, that we're not going to encounter any major hurdles here. There's always going to be headaches. If you can feel confident that, hey, at least we know that we're not going to get the brakes thrown because of some zoning issue or some neighbor's going to give us a hard time, you can focus on all of the other things you got to think about. So, yes, James, yes, you can quote that: agricultural value add light manufacturer. There you go. Assuming somebody comes forward with, all of the documentation that they need for their sort of pre-launch venture and they've done their homework, they get that meeting with you, you say, okay, great, you've got what you need. What makes a new venture fundable? Are there any kind of metrics or characteristics that you like to see, whether it's, kind of sector specific or whatever?
Yeah, and I think we can also answer one of the questions maybe about the SBA average size, just
sure,
talking about where things are, right? So, when you look at it, I would say, the first thing that you got to understand about, is the venture fundable is, what kind of partnership can you make with a bank, right? So I have, the first myth that I have to dispel is there's no 100% financing out there, right? It's a little different than the housing market when someone comes and says, hey, I need $1 million. And you say, how much are you going to put in? And they're like, I need $1 million, right? And so we got to start looking there. And so the equity traditionally, and there's some exceptions to this, is about 20% that we are expecting the borrower to put in. So it's usually an 80% bank loan. Again, some changes with real estate, all that kind of stuff, right? So there's caveats, but I would just tell you, think ballpark, you need about 20%. And that's going to have you and your investors bringing that, and it's going to marry it with the bank loan to get you the 100% that you need, right? So that's going to be kind of the first part, is making sure that you have that equity. The second is kind of understanding your experience. So, a great example is I had someone come to me and they were a home brewer and really had only brewed on a 1-barrel system, and they needed $5 million and they were going to start on a 30-barrel system. And there's a lot of heartburn there, right? And there's a lot of heartburn because I will tell you, I've been around long enough. I'm not a home brewer, I'm not any of that stuff, but I know that it's very hard to translate your experience from a little 1-barrel system in your garage to a 30-barrel professional system. So kind of, the small pub where you're going to do a 1-barrel or a 3-barrel, the home brewer really easily kind of transitions to that. But if you're saying, hey, look, we're going to go really big and we're going to have 120-barrel fermenters, and we're going to have all these other kind of things, experience matters in that place. So it doesn't necessarily have to be the main owner, but someone that has some equity in it, depending on the size, really kind of needs to have that experience, and they need to be tied to it. They can't just easily walk away and say, yeah, no, that was fun. The other part is we talk about loan size, and I would say that generally, and so I lend across the US right now. And I would say that generally on a startup, and geography makes a difference, right? So where the cost of living is less, these projects cost less. But I would say that, generally right now, the average, startup request is somewhere between 750 and 1.5 million. That's what I would say that generally we're seeing right now. And that includes either real estate or leasehold improvements. It is all the equipment, it's some working capital, it's kind of all those pieces. So, once you get a startup project kind of over 2 million, you really kind of have to be able to justify it, because that's a pretty lot of load, right? One of the things that I always try and think about is I'm starting at $0 in revenue, and, a $2 million loan is, 15,000, 18,000 a month in payments. It's somewhere pretty high, right? And to go from zero to just debt service takes a while, where if you take a $500,000 loan, maybe you've got a $3,000 or $4,000 a month payment, depending on things. And so it's a lot easier to kind of get back to profitability. So sometimes you want to see that in stages, is like, hey, we're going to start out here and we're going to add this, we're going to add this. And it usually helps from getting too far out. And then just kind of understanding what the loan use is, right? So right now, if you told me you were doing a $5 million only focused on distribution, it would make me nervous for you, right? Because the shelf space is really crowded. The draft sales to restaurants haven't really come back to where they should, right? And so understanding what's the use. So the loan size, the loan use, kind of understanding your equity and experience are all pieces that come together that say, hey, is this a deal that we want to jump in with? And those are the important pieces.
Yeah. And I liked what you said about the sort of loan size and matching that, and, starting from zero, the ability to kind of take steps up along the way. So that's an option for somebody who says, hey, I'm opening a cidery. I think initially I'll be starting a tap room. At the end of year one, I'm going to start local distribution. So I'm going to need some additional step. So working with a bank, having that kind of phase in plan, so they're not stuck with this significant debt service when they're really limited in their sales channels. That's an option. Just kind of being upfront with the banker and kind of coming up with some solutions for the realities of the lived world here.
It's 100% a reality. And Chris, you earlier said something about sleeping better at night. A lot of the brewery owners that I know that sleep very poorly have really, really big brew houses and brew really, really, really big batches, and have their sales force everywhere saying, you've got to sell every single pint of this beer. And the guys who sleep pretty easily are the ones that are, rocking an 80-85% margin over their bar. And they're saying, yeah, this is pretty exclusive and elusive. And we've got a couple bottles that go out the door, and we've got a couple 6-packs that go out the door. And you'd be surprised at year 3 or 4 how the owners, and it depends, right? And all this is going to be up to you, but you'd be surprised at how many owners at year 5 on big production facilities still haven't taken their first dollar. And a lot of brew pub owners and small taproom owners are already pulling $150,000, $200,000 out of the project, because their margins are so much better and they're just kind of that local neighborhood pub. So you got to decide, are you doing this because you want to make a really good product and feed your family, or are you trying for world domination? And those are two definitely different paths, and the income generation is very different in those two.
Yeah, no, that's a very good point. I think having a model that works for the location, the context, and the current time, right? I mean, there are still some underserved markets out there for different products, but there aren't as many as there were 10 years ago. So when you see somebody's plan that says, well, we're going to be a brand that blankets the East Coast, we're going to be, in massive distribution, there needs to be a really compelling justification for those assumptions. So I think there was a question here about if in your pro forma there's a plans for distribution with your Costco or your Whole Foods, would you want to see that in the pro forma? Do you need to have kind of a sort of kind of letter of intent style contract in place? And I'll say from my perspective, you probably won't be able to secure a placement pre-launch, and unless you are a pretty large company that's being spun off from somebody else. It happens every so often where a kind of known quantity might kind of leave their company that they've been a while. They open up their own venture and they've got serious backing, so they know they're going to be able to kind of rely on previous relationships to say, oh, well, I have a really great relationship with Safeway and Food Line. So I know I'm going to be in 40 stores the day I line up distribution, and I'm going to get the attention I need from my distributors to service all those. Okay, then that might be, there's some grounding for that assumption. But I think everybody who's here, and we're going to turn to existing companies in a minute, everybody here who's here is working with distributors knows that it's not getting any easier to get prioritized. They have very big books these days. So they're going to want to, you're not going to want to necessarily go out there and assume that you're going to be able to get these placements unless you have it more or less in hand based on kind of previous history with them already. Does that feel about right, Jason?
It does. And maybe I have two, I don't know if they're adages of wisdom or not, but I will share a couple of stories being around for a while. I had this was not an alcohol company, but I had a creamery company that does, they did milk and yogurt and things like that for a very big retailer. And all of a sudden they thought 97% of their product was going to that retailer, right? And they thought that they were on cloud nine, that retailer had given them equipment. They just thought they had hit it a home run. And someone else bought that retailer, a very large company bought that retailer, and all of a sudden said, hey, we really appreciate you being part of that retailer, but as of, and they gave them like a week, we are no longer buying your product. And so 97% of their product that was going out the door was no longer going out the door. And so similar to beer, they had problems with, oh my gosh, we've got to get this out of our place and onto shelf somewhere. And within about 3 weeks, because they were so leveraged, without 3 weeks, they were hemorrhaging cash. And about 6 weeks later, they had declared bankruptcy. And so for us, as we're lending, and I would kind of say the same thing in COVID, right? You had so many people reliant on, hey, we don't sell much in our tap room, but we sell a lot to the local bars and we sell a lot in distribution. And when COVID hit and restaurants closed down and that went away, it made it really hard. So my advice, and this is the advice I would want someone to tell me, is, be cautious about being over leveraged, and then also make sure that you have multiple revenue streams. So make sure you can handle it, right? There's so many people who are running for canning equipment in the pandemic, or doing crawlers by hand or doing things like that. And so, it's, the bank loves to see the fact that you're going to have a great distribution agreement and your product's going to be in Costco or things like that. But I've heard so many people talking about the Taco Mac crush or the Costco crush, right? It's 1 month of just absolutely going. And then all of a sudden, it just falls off when Costco features the next brewery of the month or something like that. So just make sure you're not completely, or at least my opinion, make sure you're not completely building your, on that one golden goose, or, if it doesn't lay an egg, you're going to be in trouble.
Yeah, those deals can be fantastic. I mean, great capital infusion, but if you're reliant upon that or sacrificing kind of steadier growth opportunities, that can be pretty difficult. So I think fitting that into your overall production, distribution, sales channel stuff, that's a really key, both in the early stages and certainly when it comes to companies that are going to look for financing to scale. So with that, we can turn to existing companies that are looking for additional financing. When should a company begin to prepare to recapitalize? What stage? When should they start kind of begin the process?
Yeah, so I would always say that they don't get their act together early enough, right? So, I would say from startup, if you think you're going to need to do it, that's the time to make sure, initially you have good accounting practices in, right? You've got a POS that's telling you your data. You've got a good either bookkeeper or someone on your staff that can understand, create a P&L and a balance sheet. Understanding, making sure that your tax preparer, as you start to say, hey, look, we're going to need to scale. Don't take all the revenue out of this company. Don't bring us down to zero or negative, because the bank wants to see historic cash flow. And ideally, when we're looking at expansion, we're going to go back and look at the last 3 years. Now, my number one question right now with COVID is, what do you do with 2020? And I would tell you that the bank wants to see that you've created most likely a V. Now, some breweries, even in 2020, did this, right? Because they started in 19, 20 was better just because you didn't have any sales in 19, 20 was better than that, 21 has gone up, right? But if you were here and then COVID took you here, we want to see maybe you're not all the way back, but you're up, and we want to make sure that you're not going down, right? So kind of understanding where your financials are. The metrics are a little different, right? So when you're doing when you're trying to recapitalize, whether that's taking on, adjusting debt that maybe you had, maybe you started with high debt, and some people use credit cards to finance that, and some people use 8, 10, 12, 14% kind of, oh my goodness, hopefully we can make this payment kind of debt. And so sometimes the recapitalization is just, hey, I need to get the debt wrangled around, right? And so you can kind of look at it and say, if we do some of these things, does it get them to the right profitability? And you can make that adjustments. If you're going just to say, hey, look, we're here and we want to go here, some of those other things are looking at, you have to build a pro forma again, right? I have to know where are we going. And so we usually want to see, the very minimum that you're going to have is you're going to have to be break even, right? So you have to have at least enough revenue to cover all your fixed and variable costs and your debt service existing, right? You may have to say, hey, we're looking at, normally we want to see a ratio higher than that. You want to see a 1.15, which means that you have 15 cents of income over the debt per dollar that you generate. Ideally more than that. I mean, whatever, we want to be on that +1 side for sure. But what then you're looking at is, what's the purpose of this? And I always joke that I tell people that your mama would be proud that I tell you this. Just because someone else is doing it doesn't mean you have to do it too, right? And so we have so many people that say, well, I got to expand. And you say, why? Well, because everyone else in my city is expanding. Well, okay, but why? And, a lot of times I'll say, are you making a lot of money? What are you doing? And they're like, well, yeah, we're pretty happy with all this. And, I'm like, all right, well, why? And so if the answer is just because, I always tell them that's not a good reason. You got to know, like, we have a market that's underserved. We can move to this different location, and this gives us much better foot traffic, and we can do these things. So you kind of got to know the why behind wanting to do it. And so the two pieces are making sure that you've historically, taken care of the business, and that you understand future where you want to go. Those are the times where you really say, okay, I know these two pieces. I know that we're good, and I know why we want to do it. Then you should be talking to the banker at that point. That's the time to get them engaged. And that may still be a long run, because you may say, hey, we're not going to do this for a year, or this building won't be ready for 18 months. And so you're starting pretty early. But that also helps with the consulting is, hey, send me your quarterly financials, and we can say, hey, this isn't going the way you should, try and adjust this, do something like that. I tell people, and it's a little bit different than everyone else, I'm not a commissioned guy. So if you want to start talking 24 months before, and Chris, I'm sure you want to start talking to them pretty early on too, I'll help you quarterly through. Let's talk quarterly. Let's make sure you're on the right path. Let's talk about what can we do to make you even look better. Are you holding back enough cash to build up kind of your dry powder? And so there's a lot of advisory that can be given if you start and know early enough that you want to do it. The worst thing to do is go, oh no, we need to move, or oh no, we need to expand, and we haven't done any of the prep work, because a lot of times that's when you start running into trouble.
Absolutely. Having those milestones in hand, saying, hey, we want to make sure that we're achieving what we're wanting to do along the way, having those conversations, saying, okay, before you're stuck kind of holding the bag, because it can be very frustrating if you find that you've got an avenue for growth. Let's say you're opening up a new territory and you need to produce more product, you're exceeding your expectations, and all of a sudden you say, oh no, I'm not going to have enough product, and I'm going to have to short somebody. I need to get a tank yesterday. Well, anybody who's been trying to order any equipment recently knows supply chain issues are a huge headache right now. We're actually doing a webinar on supply chain issues tomorrow. And everything is taking longer. So I would say, even if you're notionally say, hey, based on our projections, we think that we're going to exceed our capacity in 18 months, working backwards. It used to be, a 4-month lead time to get this equipment ordered, produced, and installed. Maybe let's double that now. Then we need to have the money to finance that. So I should be having this conversation now. It feels like a long way off until you start backing up and adding in all those buffers that we need to right now, since nothing is flowing as freely as it did a few years ago. Yeah. So yeah, start early is the answer.
Yes.
Yes, but but with very, be purposeful too. It can't just be money for money's sake. It has to connect to profits. So, so with all that said, again, you decided not want to start having this conversation. Somebody comes to you now, they're, an existing company. When you're assessing their loan worthiness, are there any kind of different things you're looking for an existing company versus somebody who's in that kind of pre-launch phase?
Yeah, so it's kind of piggybacks off of what we were just talking about is, how have they historically performed, right? Have they paid their debt as scheduled? Are they over leveraged? That's one thing that always makes me a little cautious is someone, has equal debt to top line revenue, right? You've got $2 or $3 million worth of loans out there, and you only made $1 million top line or $1.5 million top line, right? And kind of understanding that. So, are you over leveraged? Do you have capacity to take on additional debt? Are your projections really out there? Like, I've had one where someone says, "Hey, look, we're gonna go from we're producing 400 barrels now, and next year we're going to produce 2,000 barrels." And I'm like, "Well, where's that 1,600 barrels going to go? Do you have the sales force to do it?" So being able to kind of understand how realistic, right? With startups, it's a lot more. It's a lot more open to interpretation with historical. I tell people, with a projection, I just assume the projection. With historicals, I'm going to be a lot more, your projections are going to be a little bit more under the microscope because, you've got to be able to do that. But it's really, when is someone ready? It's, kind of three places. Have they historically handled their business, right profitability, right debt? Are they paying the debt down? Have you got kind of the places, when you talk about the distributor, is a distributor calling for more beer? Have you reached max capacity? That's always a question that I like to ask, right? So if you are making 1,000 barrels of beer, well, I talked to someone the other day and they were at 2,500 barrels, but their max capacity was 7,000. And I'm thinking you need to be kind of in that 6,000 to 6,500 barrel range to say, hey, we want to be adding a lot more. If you haven't hit your full run rate, that's something. Is there someone who's saying, hey, I'm just throwing things at you to come have you move into our city in a second location? You just kind of understand that. And then making sure that all of that, can get tied together. Does the business plan work? Does the projections work? Is it something that you're going to lose a key component? You have to sell off a bunch of equity. So, a lot of it is just kind of looking in the review, but also going back to the why. Why are you doing it? And, are you ready to grow?
Yeah, that's a great point. It can't just be the numbers. There needs to be the context and the story, right? What are you hoping to achieve here with it? There's numbers alone aren't going to get you there. There's too many variables at play.
Yep. So,
speaking of variables at play, I know this is going to be a tough one right here. If a company is they realize they need to recapitalize. How would you suggest that a company determines what its capital needs are? What basically say, hey, I knew launch, I just said 750,000 and we made it work. We cobbled together what we needed. When you're in that expansion phase, how do you suggest that somebody kind of start putting numbers together as, well, what is that dollar value?
So market conditions become a big part of that, right? So, as you look at it, maybe, in that example that we talked about earlier, maybe you do want to put a still in and you want to sell cocktails by the drink and you want to, you need a bigger brew house and a canning line because you now have canned cocktails and you have other things. That's one of the reasons you go and say, hey, look, can we do this, right? I always first, this is a little bit crazy to say, but I always look and say, can you do it out of your own cash, right? A lot of times, business will be sitting on a big chunk of cash and they'll say, well, but I want to take the debt because I got to protect the cash. And sometimes you got to say, well, put some of your cash in and put some of your debt together because your ROI is going to be much faster. And so I always look at it in kind of a backwards place and say, okay, if I spend my money here, what revenue is that going to generate for me? Because sometimes people do stuff and they say, we've just got to do this. And I say, great, what's it going to return revenue? And they're like, well, no, it's not going to really return any revenue. And I'm saying, well, why are you doing it? Right. And so you got to look at that. And, the market conditions of construction right now is that good example, right? So we've got a expansion going on, and we kind of had them go through the needs plus the wants, and so some of those things were like, I want a fireplace and seating area and things like that. And I'm like, well, what's that going to cost you? And in this environment, it was going to cost them like $30,000. And I'm like, and what's the return on investment on that? Well, not really. Okay, well, we're kind of tight on the budget. Can that be cleared? And they clear that, right? So, you kind of got to look and say, is this, I understand that a lot of it will kind of help your brand. I was visiting a brew pub the other day that was originally it was originally a New Orleans themed restaurant. And they have some things in there that they just didn't take down because they're like, it really didn't affect what we were doing. It was going to cost a lot of money. We were going to have to move pipes. We're going to have to move things like that. And so just being able to look and say, what generates the most revenue? So I would tell you in today when expenses, so, equipment's more expensive, construction's more expensive, if today is the day that you need to do it, it's probably looking at how do I return, the most revenue to me. If it's 6 months down the road or a year down the road and, things have become a little bit more in line, you can say, this will help with ambiance, this will help with things like that, it'll help with our brand, and maybe you can look at it. But I'm just going to, I'd look and just say the two things, right? Could you, are you really going to have to ramp up sales to, fill the capital need? Or can you, make this payment on what you're doing now? And then two, what is going to be your return on investment?
That's great. Well, I know I want to leave time for some questions. I see we've got 4 or 5 in there now. So one last question for you, Jason, before we turn to audience questions here. And I'll let you kind of choose which are the most entertaining stories here. But what are some of the most common or most egregious pitfalls that companies fall into when seeking capital? We don't need any names attached to any of this, of course, but any kind of things that you see come up and you say, oh man, that was they didn't need to do that.
Yeah. So the number one is everyone being a little too excited about jumping into the business on a startup. And they say, we're all going to quit our day jobs. And, I've had a couple where they were all very obstinate to do that. And that, I always say that a startup brewery can barely support one salary. I mean, it can support all your staff, but it can very rarely support one salary, let alone you got 3 or 4 partners and they're all jumping in. So I would tell you that the bank is going to appreciate it. Your mortgage company is going to appreciate it. Your car company is going to appreciate it if you slowly ease people in, right? So maybe part-time with one job and part-time at the brewery or distillery. And it really can't support that full-time job. But that seems to be the number one thing people want to do is they want to say, they love telling me, I'm all in, we're quitting our job. And I'm like, that scares me to death. Can you be a little less all in? And that will make me feel better, right? So don't feel like you have to, that's not something the bank's looking for you to just say, hey, I'm going to quit my job. The other is just getting too excited, right? And coming and, I had a startup the other day and say, it's going to be a $10 million startup. And I, after I, picked myself off the floor, I said, why does it have to be a $10 million startup? And so, having this, it's going to be the biggest thing ever kind of thing, is something that you have to do. So start small, start humble. There's plenty of brands out there. And I always also say is, don't get too in your business plan. I always say focus on your brewery, distillery, winery, whatever. My favorite thing that I joke with them is, in there they say the problem I'm solving. And I chuckle with them. I said, you're not really solving a problem. There's plenty of great beer. You are doing this hopefully for you, right? You like there's things in the world where a business gets started to solve a problem, but the next craft brewery or craft distillery did not solve a problem necessarily. It may be that your hometown doesn't have one and you feel obliged to go back and solve that and do some things. But that doesn't necessarily mean that you're doing that. And then, the number one thing that I see is, just not having realistic expectations when the bank comes back and says, hey, you wanted this and we'll do this. It's not exactly everything you want. Don't take that as a personal attack. Don't get upset about it. I always look at it, the bank's job is to manage risk. And so when you look at a project and say it's just too risky, they're going to come back and say, this is what we can do. And that may be, you need to put more equity in. You may need to secure piece of real estate with a house. You may need another investor. You may need something like that. And so look at it and don't, you've got to separate yourself a little bit from the business and not get so emotional early on, because if you do, the right funding may, get out from under you just because you kind of cut your nose off to spite your face. So that'd be the last one. Is just, I'd say, talk to a lot of people, find out what other people are doing, and then, try and understand what the market is demanding at this point.
Yeah. And I think it's always important to remember, whether it's a bank or investors, whatever, everybody is out there trying to kind of turn a profit, but they only make money if you make money. So don't be too offended if somebody says, hey, we want to see some adjustments made here. You want to stay true to your business plan, but you also have to realize that their ROI only comes if you are seeing profit. So with that, I'm going to turn to our questions, because we've got a number to get through here in our short time. So I'm just going to fire them off real quick, Jason. You can answer here. Is it all right to use a different bank for your business checking account and a bank you may use for an SBA loan or investment?
So in our case, our bank is in the Southeast. So when I'm dealing with something, in the Midwest or Washington, for example, we're not offering them the deposit banking. So it is quite all right with that. Some banks, depending on the bank, will make it a requirement that you bank with them if they give you the loan. But it is completely acceptable to have a loan one place and bank somewhere else. I would tell you, though, if you're going to have a line of credit, it's important to have a checking account where you have that line of credit, just to be able to flow money back and forth and be able to quickly access the funds.
Sure. Great. Next one is 2 questions. First, will we send a link for this and other Zoom webinars to everyone? I may ask Amanda to put that in the chat, but this will be posted on the SBDC's YouTube channel. And I think there will be opportunities. Amanda, do you have anything else you want to share on that?
Yeah, definitely. It's going to be posted in a couple places. So past webinars can be found at virginiasbdc.org/training, and as well as our YouTube page. I think we'll probably also send the recording out to everybody who attended today. So
great, thank you. The other question was, are there other non-traditional lenders, such as Virginia equivalent of North Carolina's Self-Help Credit Union or Goldie Foundation? Yes, there are organizations like CDFIs. There are other funding options that are out there. Obviously, it's better if they have some experience with this industry, because it doesn't work the same way. It's pretty high capital investment. It could be, if somebody doesn't understand how to read sales projections for a brewery, they're not familiar with the 3-tier system, they're not aware of all the ABC laws in Virginia regarding distilleries, they may not quite understand, the numbers wouldn't look right. So somebody that has an understanding of this industry in Virginia is going to be best. And you can always reach out to me if you want any kind of insights on that front. So happy to be a resource on that. Corey asks, is crowdfunding where an owner loses no equity, such as Kickstarter, Indiegogo, et cetera, a legit way to bring in funding? Or is somewhere like Mainvest or WeFund or better? He's not familiar with those. So
yeah, I would tell you, I had there's a client that we're looking at right now, and they actually, have used, well, a lot of them, not even just this one, right? But a lot of brew pubs use something like a mug club. And so they go out and they sell $100 memberships, and they, kind of put these pieces together. And so it's pre-sold revenue that they can have, or like a lot of these places that maybe are mead makers or something like that. We had there was a group recently that raised a couple $100,000 in pre-sales. So they, these people are willing to wait 18 months or 24 months, and they have put money up front. So the bank's going to look at it, as long as it's assets in your checking account and you're entitled to it, and there's no clawback, then it's fine. You don't have to give up equity to get the crowdsourcing. So you can find other ways. Kickstarter is hard, especially if you're trying to raise $200,000. Giving away t-shirts and a free beer is really hard to get to $200,000. So it really also depends on what your raise is going to be. If you need to raise $50,000 for a $500,000 project versus I need to raise $300,000 for a $3 million project, those are two different sources. So I think, it just depends on where and how you need to raise the money.
Yeah, that's a great point. And I think being aware, first of all, with permissible, you want to make sure you're doing things in the right way in terms, because this isn't, a pretty highly regulated industry. And I've seen people use your Kickstarter type things for very discrete aspects. So if we say we want to build out our tasting room, or we want to put in a new patio. So if it's funding a specific portion of a project rather than just going into the general fund, it might make it easier if you're also going out to seek loans so it doesn't muddy the waters too much. Greg asked, how concerned should startup beverage businesses be regarding the reaching the saturation point from a supply demand point of view? I could take that. It is getting more and more crowded every day, for sure. So making sure that you have a unique value proposition to offer here, whether you say, hey, we want to serve a local community that's underserved, we're going to go have a very niche product, right? So we're saying we're not just going to do all distilled spirits the way other people do. We're really passionate about rum. Okay, that's a market position that's not being filled, or at least not as heavily as others. So there is still space. I think that specialization is kind of what happens naturally in the space. So Jason mentioned Colorado for beer. There are an insane number of breweries in Denver. It's amazing that there could be that many, but it works for a lot of them because they are carving out a specific role in that overall marketplace. So part of it is growing the audience, part of it is getting people to trade up to kind of locally produced craft products, but part of it is also making sure that you're clear where you fit into the overall market. Let's see. I see another one here. I'm hoping I'm getting to these in order. Are there grants or funding available specifically for minority-owned breweries? There are some grants that are out there, some educational programs that are out there in particular. So there's grants for somebody to go get formal, brewing or distilling training and things like that. There are other grants that are out there for not necessarily minority-owned breweries, but for minority-owned businesses, or there's a minority business development agency. There's all kinds of programs and incentives for all kinds of groups. So if you want to kind of look through the options that are out there, you can always reach out to us and we can help you assess what might be out there, because we didn't talk about grants today. There's, money is a huge part of this industry and we're never going to cover it all in an hour. So grants, even support from local economic development organizations, that might be something to be looking at to kind of round out the picture. As a distillery that opened in March 2020, this has been an interesting year. We have no loan debt. So when is the best opportunity to seek an infusion of capital?
So that was kind of interesting because, clearly you've been operating for now about 7 months. And so it's definitely everything that we talked about in the startup is really the application. So historically, I don't know what you're distilling. So I don't know if it's gin and vodka and, white rum, and you've got some great sales, or it's, you're looking for a 3 or 6 year bourbon. Those are two clearly different revenue streams that you have. I would tell you it's worth having a conversation. I'm happy to evaluate some things if that's something you want to do, or, go to the bank where, someone talked earlier about you have to, but sometimes you can go to the bank where you have your deposits and you can kind of say, hey, I've got this much in the bank. Would you give me some money? And then part of it is going to be, what are you going to use it for? So are you going to use it for another still? Are you building a rick house? Are you buying cooperage? What are you doing with it, right? Because the fixed assets are going to be a lot more lendable in the early stage than you just going and saying, hey, I need a bunch of working capital and you've been out for 7 months. I'm assuming, unless you've sold a lot, that you probably are not at break even yet. And so just kind of understanding where it is. So I would say that you should kind of treat yourself still at month 0. And you may have some market acceptance and some concepts you can go from there, but still your financials are going to be projection based.
TJ has a question, which I don't think we're going to be able to get into too much. Things like terms such as tranches, prepayment penalties. There's lots of kind of jargon associated with this industry, and just understanding how, if you're going in there, they're saying, well, how about a rotating line of credit, or would you want to have tranches, and what are the sort of, that's when funds are kind of dispersed over periods of time, often in connection with a completion of a goal or achieving a certain sales level, let's say. We can help with some of the education on that front. Don't be too scared. Ideally, if you're having a good relationship with your banker, you're not going to take yourself out of the running because you don't have all of the industry specific language. We can help with that. And if your banker is not going to like you on that, or not going to be interested in funding you anymore, maybe that wasn't a good fit in the first place. Which leads us to the last question, and I think we're going to hopefully get it right under the wire here. How can someone best present themselves as a person and someone the bank can trust on top of good numbers? All of this is, as we mentioned, this is not just about the pro forma, there's a kind of personal element to this. So how does somebody kind of make sure they're in the best position on that front?
So I think summarizing it very quickly, the first part is just transparency and you laying all the cards on your table. I've done it before where someone hit a bankruptcy and all of a sudden that basically kills the deal, right? So they didn't tell you about it. They actually left it off a form and then you find it later. That pretty much immediately is the downfall of that event. But I would say that right now in the market condition is just being as transparent as possible. And when Chris, you've seen this before, ghosting has become really, really high. And sometimes it's intermediate ghosting. So if someone doesn't know the answer, so they just ignore the call. They ignore the call from the GC, they ignore the call from the banker, and then they say, oh, I figured it all out. And you're like, well, where have you been in the last 3 months? So, sometimes if someone calls, just says, hey, look, you said you were going to send me this, you never sent it to me, you say, look, this, and this got in my way, and it's still a priority for me, and I'll get it to you. So just be transparent and keep open lines of communication. And then the other thing is just, if you've got a ward on your deal, own it. Hey, I got bad credit, or hey, I don't know everything about this. And so if you can just leave open lines of communication, that's going to put you in the best foot forward. And when someone gives you a piece of advice, you may not follow it, but at least consider it, and don't say, no, that's stupid. I can't believe you'd suggest that, banker, because I've seen a couple of them, and I generally say this is how the deal is going to get done.
Awesome. Well, Jason, thank you so much for sharing our expertise. I feel like we could have gone for 3 more hours, but I know this is a big topic. So thank you for your time.
Thank you.
All right, thanks, both of you. So to close us out today, I just want to remind everybody, as we mentioned before, you're all going to receive an email with a link to the recording. If you would like to sign up for upcoming webinars or access recorded webinars, please visit virginiasbdc.org/training. I also shared the link to the Craft Beverage Assistance Program in there, as you can also find Chris's contact information there. You can also access on our website the COVID Business Recovery Center, which we developed to help owners not only continue business operations, but thrive and recover. These resources are designed to be used in collaboration with your local SBDC advisors, and you can sign up for a free and confidential session by emailing help@virginiasbdc.org or via our website. Thank you all so much for attending today, and we hope to see you on our next session. Thanks.
Thanks, everyone.